Good day to all. Today we're going to discuss about the second part of property, plant, and equipment involving subsequent measurement, depreciation, and revaluation. Please take note and kindly visit the discussions involving part one, which talked about initial measurement, the initial recognition principles, also with the specific attributable costs that are to be added to purchase price involving land, building, and machinery, as well as the other concepts. So now we will continue with such. This is still under IAS 16. Our learning objectives would be, we should state the subsequent measurement of items of property, plant, and equipment, or PPE. We define depreciation and state when depreciation commences, when would that begin, and when it ceases or when would it stop. Then we also account for the revaluation of items of property, plant, and equipment. Now, subsequent measurement, as the word subsequent means, it is how do we measure, how do we assign values to our property, plant, and equipment items after the first time that we have recognized it, which is initial recognition. And normally we do this at the end of the accounting period, in which we have to update the balances of our accounts. So we have two models, the cost model and or B, the revaluation model. As its accounting policy and should apply that policy to an entire class of property, plant, and equipment. There are actually groupings for property, plant, and equipment. Let's say land would be one group, buildings would be another, machineries would be another, equipment could be another. Some would be lumping machineries and equipment, that's fine, for as long as they have similar characteristics of such property, plant, and equipment items. And whatever the model, it should be part of the accounting policy of the company. Is it possible to have mixture of the two? Yes, because as said, it shall be applied to an entire class. So it's possible that cost model, let's say, will be applied for buildings, but then for the land, the company chose revaluation model. The evaluation model is something nice because it would update the values of the property, plant, and equipment. Next, for cost model, for subsequent measurement, we are going to present the item of PPE at cost, less any accumulated depreciation and any accumulated impairment losses. Cost, of course, is the purchase price plus all directly attributable costs discussed in part one. Accumulated depreciation is the sum or summation of all depreciation expenses recognized throughout the period. And then the impairment would be when our recoverable amount or the amount that we can get estimated for our property, plant, and equipment would be lesser than its carrying amount. Such will be discussed furthermore in other standard, which will have sometime later on, but not in this video. So depreciation expense will be discussed in this video, of course. All right, so followed by the depreciation, in which, as explained, is the systematic allocation or the rational allocation of the depreciable amount of an asset over its estimated useful life. We do this because normally a property, plant, and equipment can be used for more than a year, and it would benefit more than a year also, more than one accounting period. Say, for example, the useful life of the asset is 10 years, so the PPE's cost would be allocated to the 10 years because it would benefit those years. It would be unfair for the company to expense that outright and would affect the profit or loss. Now, please take note that for the PPE items, normally they are depreciable, meaning we have to allocate the depreciable amount of that property, plant, and equipment over its useful life, with the exception of land. Since normally speaking, land's value would increase over time. That's why it is non-depreciable, with a very few exceptions, like land is being used as a waste area or dump site, wherein instead of increasing the value, it would decrease the value. So that is just some sort of the exception to that rule. Second point is that when computing for depreciation, each part of an item of PPE with a cost that is significant or that is significant or material or substantial in relation to the total cost of the item shall be depreciated separately. It's possible like the parts of an airplane wherein the engine could be one major part, the wing, the shaft or the body, let's say the gears. So those could be significant parts in which they can have different useful lives. That's why they will have to be depreciated separately. Hopefully it's clear that we do the depreciation because we are aware, hopefully, that the value of a property, plant, and equipment would basically decrease over time, and that it actually will have resulting to its functional capability also to decrease. So that's why we have to do the depreciation concept or method. If we are asked, it is again a systematic and rational allocation process. Okay. Why though? Why is it systematic and rational allocation? It is systematic because there's a process involved, there's a formula to follow, and normally we will do the depreciation table or construct it. And then it's rational because there's a concept behind, as explained a while ago. Depreciation begins when the asset is available for use. That is, when it is in the location and condition necessary for it to be capable of operating in the manner intended by management. So remember, we've said in the previous discussions that we've had that a PPE, property, plant, and equipment will have to capitalize the costs up to the point that it is already available, it is already capable, or it is already usable by the entity for its intended use. And so if it is already available for use at that point, therefore depreciation begins. And then in the depreciation concept, what we can do is actually consider it at that point, at the start of the usability and the utility of that PPE. And even if it is no longer used temporarily, for example, like a car being set aside for the meantime, and we haven't reached yet the end of the useful life, it is still depreciated or it is depreciable, because whether a usable asset is used or not, its functional capability and value would really decrease, just like a car. If it is used or not used, still its value and functional capacity or capability will decrease over time. If it is used, well, of course, the components are being geared, being tested towards fruition and use, maximization or optimization of the functional capabilities. But if we do not use such, remember the elements, normally the natural ones like moisture, like air, let's say water, rain, and other things would be acting as deteriorating agents of such. So that's why depreciation would still continue. Next point is, when would it cease? When would it stop? It normally stops or ceases when the asset is derecognized. The recognition, as explained in the previous chapter, is that when there are no more economic benefits embodied in the property, plant, and equipment, and therefore it has to be removed from our financial statements. The recognition means that is the exclusion of a certain accounting element from or of the financial statements. One example is when it is classified as held for sale under PFRS 5, which is another accounting standard, wherein, for example, a property, plant, and equipment item is to be sold. And this particular classification is when at least 95% probability that it can be sold. So that's going to be the case that we are going to classify a PPE as held for sale. And with that, it is no longer PPE. It is under PFRS 5, whichever comes earlier. Now, this is very important. Even if a certain property, plant, and equipment reaches the end of its useful life, but the company still uses it, then that particular PPE item shall not be removed from the books of the company. So it should be shown as part of the PPE. It's just that its cost and or depreciable amount, because there is salvage value. That's why you mentioned a while ago about depreciable amount. Let us go back to that part here. Systematic allocation of the depreciable amount, since if we have salvage or residual value, which is the value estimated for a PP item, that can be obtained when we sell it or dispose it at the end of its useful life, then that would have impact to the amount that will be allocated over the term. Since the salvage value or residual value or scrap value is something that is guaranteed to be received at the end of its useful life, in that sense, though, estimation, because estimates can change along the way, but it's like the concept is when there is residual value, it is guaranteed that something will be received, but not exactly the amount. Hopefully that is clear. And then the depreciable amount is cost less salvage, or also known as residual or scrap value. Take note of the terms that I've said or we've said. And then that's going to be the depreciable amount or cost. But if there is no residual value or scrap or salvage value, that means that our cost is the same as depreciable amount. To continue. So in that case, again, depreciable amount is the amount that will be allocated over the useful life. Next, for selection of depreciation method, we have to take note that the company will choose the company in representation of the management, who is the one that is primarily responsible for the fairness and reliability of financial reporting, but the accountant also could be involved. It's just that the management is the primarily responsible party, or the signatory or signatories, or the party that would represent the entity. So in that case, such would most likely select the method that most closely reflects the expected pattern of consumption of the future economic benefits embodied in the assets I'm reading it. It simply means that the method should properly represent or reflect the expected pattern of consumption of the benefits embodied or contained in such asset. Since we will know that not all PPE items will have same patterns of the consumption of their benefits. Some would simply suggest that it's okay to have straight line method, which is the most common depreciation method that we learned even from accounting 111, or the fundamentals or basic of accounting, or basics of accounting rather, or basic accounting. And then in that case, so just simple passage of time, just simple depreciable amount divided by the number of years. So it's a straight line method, constant charges or constant periodic charges. So in that case, that's the pattern of the consumption of the future economic benefits. However, that's not always the case. However, a depreciation method that is based on revenue that is generated by an activity that includes the use of an asset is not appropriate. So that's the caveat, or that's the warning of our IAS or PAS 16, property, plant, and equipment involving the depreciation method. That basis for revenue is not allowed. Now, here are our common types of depreciation method. As explained a while ago, we have straight line method, in which we recognize constant and fixed periodic charges over the life of the asset. As said here, it is evenly recognized. And then the formula is depreciable amount divided by the estimated useful life. We have to take note as that our depreciable amount is historical cost less the residual value. And this would be our depreciation should we substitute the values on the formula. Next method is sum of the year's digits, or SYD depreciation, in which we are going to develop fractions out of the data involving the company. So for the fractions, we are going to use the highest year value. So example, let's say we have 5 years useful life. For the first year, we will use 5 as our numerator. And then for the next year, it will be 4, 3, 2, 1. Then the denominator would be the SYD denominator formula here, wherein it is life multiplied by the quantity life plus 1 all over 2. So if ever that is 5 years, so we substitute here, let's start with the bracket portion. 5 plus 1 is 6 divided by 2, that's 3. Times 5 is 15, meaning to say our SYD denominator would be 5 and then over 15. Denominator would be 15. So numerator is 5, of course. And then 5 over 15 for first year. Second year would be 4 over 15. Third year would be 3 over 15. Then fourth year would be 2 over 15. And our fifth year would be 1 over 15. So in this case, it means that on the earlier years, the company will have the highest depreciation. So this is also known as variable charge method. In number 1, that's constant charge method. But for the variable charge method, some of the years digits is also the example, or is one of the examples, because the depreciation charges would be different over time. And another one is double declining balance method. So in this case or situation, this is going to change, be variable, but the amount of depreciation would be decreasing. If we are going to see the trend from the first year onwards, we would see that it is decreasing. So a fixed rate is used to multiply to the carrying amount of the asset. Unlike with the other depreciation methods, we would ignore the residual value. Remember, in our general rule, the computation and the formula for computing our depreciation is basically our depreciable amount, and then we apply whatever method that is. But for double declining balance method, it would be the carrying amount that is to be utilized. And then we are going to multiply with the rate. What is unique here is that we are going to update. So at the end of the first year, our cost less our depreciation expense, and then accumulated depreciation later on, because we'll accumulate all the depreciation expenses to be able to get the carrying amount. So with that, carrying amount is obtained. We will use that for the next year. We follow the same process to get the carrying amount, cost minus accumulated depreciation, and up until such time that the amount is equal to the salvage value, if ever there is. So we just have to take note of that. Although we ignored it in the computation of depreciation expense, but when we make the table, still the residual value should be sure or certain to be placed in the table as our final carrying amount or value. All right. So the formula for depreciation expense is carrying amount times rate. Then double declining rate is 2 over life. This is our formula. So if we have 5 years, that's 2 divided by 5, meaning to say our rate or fixed rate is 40%. If we go back to some of the years digits method or depreciation method SYD, we can see here that we are still using the depreciable amount, and the more with straight line. It's depreciable amount, historical cost minus residual value, right? And then here, it's carrying amount. Next, this is also variable charge or activity for the second and third. These are variable. It's just that they're commonly called as declining balance methods or decreasing methods, because if we look at the trend of the depreciation methods, they're actually decreasing or lowering. So constant, decreasing, and we have variable, in which the variable would vary depending on our activity. So example would be the units of production method, wherein our respective depreciation would be based on the units that we actually produce. So we still use the depreciable amount and we compute the per unit of output, and then that will be the value per unit. So, or depreciation rate per unit. And so we are going to multiply that with the number of units to get the depreciation expense of that period. Also, another one is the service or working hours method. It's just that instead of units, we use the working hours or service hours. So same depreciable amount is used, and we divide that again with the number of total expected units to be produced throughout the useful life, or the total number of working hours to be consumed or service hours to be consumed throughout the life of the PPE item. And then we get now the depreciation rate. And that is to be, of course, multiplied to the number of units or service hours. Okay. And then we will discuss the continuation in the next part of this video. Hopefully you learned something from this session, and see you in the next series or part of our discussions. Thank you, everyone.